Welcome to Iron Financial, the place where we forge stronger portfolios by cutting right through all the market weakness. Today, we're putting Kroger directly under the microscope. You look at their latest earnings report, and honestly, it's a battleground. It's filled with conflicting data. On the surface, yeah, you see some real strength, but just underneath, there's a ton of noise. So we're going to do what we do best, conduct a full structural analysis to figure out once and for all if this grocery giant is built on a foundation of solid steel or if it's just a house of cards, waiting for the next strong wind to just blow it all down. Okay, let's get into it. And I have to jump in here and say, just looking at the headlines, it is so easy for an investor to get whiplash. I mean, one minute you see these reports of a solid earnings beat, the stock's climbing, everything looks great, and then the very next thing you read is about lawsuits, labor disputes, and, oh yeah, product recalls. It really makes you ask the question, is all this good news for real, or is it just a facade, a distraction from much deeper problems? Is Kroger a genuine opportunity right now, or is it a trap waiting to spring on unwary investors? That's what we're here to figure out. Right. And to get to the absolute truth, we're putting Kroger through our proprietary structural stress test. It's a 5-step process. First, we're going to define what we're calling the Kroger contradiction, all those mixed signals the market is sending out. Then, we'll move on to forging the foundation, where we'll look at the pillars of strength from their latest report. After that, we do the heavy lifting in finding the cracks, uncovering all those risks that are lurking just beneath the surface. From there, we'll analyze the 2026 blueprint to see what their plan is for the future. And finally, we deliver the final verdict. This is exactly how we separate the steel from the scrap. So that brings us right to our first point, the Kroger contradiction. The central problem here, the reason we're even having this conversation, is that the market just can't seem to make up its mind on this company. It's almost like you're looking at two totally different businesses at the exact same time. One of them is a Wall Street darling, posting strong numbers, beating expectations. The other one, well, it looks like it's constantly just fighting fires on multiple fronts. Our job is to dig in and figure out which one of these narratives actually reflects reality. And you can see that conflict laid out crystal clear right here. The bull case, it's simple, it's powerful. The stock went up because the company beat earnings. That's it. Money talks. It's a clean, straightforward story that, let's be honest, investors absolutely love to see. It's quantifiable, it's immediate, and it has a direct impact on your portfolio. But the bear case pushes back immediately. That rally, it's being held in check. It's being tempered, as they say, by this whole laundry list of problems. Labor issues, legal fights, recalls. And look, these are not just minor operational hiccups. These are significant headwinds that can hit the bottom line and, maybe even more importantly, they can really shake investor confidence. These are the qualitative risks that are so much harder to price into a stock. Exactly. Headlines are cheap, right? And the noise is absolutely everywhere. Real analysis, though, that takes some serious heavy lifting. So our mission here is to cut through all of that surface-level chatter, all the noise. We have to go deeper than the headlines to really figure out if this corporate structure is fundamentally sound or if those cracks that we keep hearing about are actually a sign of imminent failure. We're here to find the real story for investors, not just the easy one. All right, let's start the stress test. Section 2, forging the foundation. Now, before we go looking for weaknesses, we have to understand the company's strengths. Every structure has main support beams holding it up. And for Kroger, those beams are found right inside their Q4 earnings report. We need to examine these pillars of strength piece by piece to really understand what's holding this whole company up right now. The headline numbers, they're undeniably solid. Let's just walk through them. Take earnings per share, or EPS. Wall Street was looking for $1.20. Kroger came in and delivered $1.28. That's a clean 6.67% beat. And in a market like this one, believe me, that kind of performance gets a lot of attention. Then you look at identical sales without fuel. This is a critical metric for any retailer because it strips out the volatility of gas prices and new store openings. It really tells you what's happening at the core of the business. And what do you see? You see positive growth of 2.4%. And finally, year-over-year revenue is up by over $400 million. You just can't argue with these numbers. This is the steel frame of the bull case right here. But the heavy lifting isn't just happening inside their physical stores. Let's be real. In today's retail environment, if you are not winning online, you are falling behind, period. And this number shows that Kroger is pushing hard. A 20% increase in adjusted e-commerce sales just in the fourth quarter. Now, this isn't just some vanity metric they can brag about. This is a critical growth engine. It shows their digital strategy is actually connecting with customers, and it's gaining some serious traction, especially in this post-pandemic world where, let's face it, our shopping habits have fundamentally changed. Okay, a 20% jump in sales is impressive. I'll give you that. But is it profitable? We all know e-commerce can be absolutely brutal on a company's margins, right? You've got high costs for fulfillment, for delivery. So when management comes out and projects a $400 million operating profit improvement from that segment in 2026, I mean, is that just a hopeful number they're throwing out there to keep the market happy? Or is there some real substance behind it? Investors have been burned by these growth at any cost stories before.
And that is a fair question. But you have to see that management is tying this number directly to a completed strategic review. This isn't just a guess they pulled out of thin air. It's their publicly stated blueprint to take their massive $16 billion e-commerce operation and finally, make it a real profit center. By putting a hard number and a firm timeline on it, they're practically inviting accountability. This is them showing their work. They're telling investors exactly how they plan to turn that top-line growth into bottom-line results.
Now, if you are looking for the ultimate vote of confidence from a company's management, this is it. Capital return. They just completed a massive $7.5 billion share repurchase program, which, by the way, included a $5 billion accelerated buyback. And then, as if that wasn't a strong enough signal, the board just authorized an additional $2 billion. That brings the total to $9.5 billion. Let me be clear, a company does not deploy that kind of capital to buy its own stock unless the board and the executive team believe deep down that the foundation is rock solid and that their share price is fundamentally undervalued. This is management putting their money where their mouth is, in a very, very big way. And right here, you have the official company line, straight from the CEO, Greg Foran. Kroger delivered a strong finish to the year. We have the right foundation in place. So from management's perspective, the case is closed. The numbers are good, the strategy is working, the foundation is sound. End of story. But any good inspector knows you don't just take the builder's word for it. A foundation isn't strong just because someone says it is. It's strong because it can actually withstand pressure. It has to be tested. And that's exactly what we're here to do. And that's what we are going to do right now in Section 3, Finding the Cracks. You see, strong facades and shiny press releases, they can hide some really deep structural problems. So it's time to grab our hard hats, our flashlights, and go down into the basement to inspect this foundation for any and all weaknesses. Because let me tell you, when you start to look closely, you start to see some cracks that are hiding just beneath the surface. Okay, before we get to the specific number here, we need to be crystal clear on what we're talking about. What is an impairment charge? I know, it's an accounting term, but think of it in construction terms. It's simpler. Imagine you spend $1 million on some state-of-the-art support beam for a new building. Then, a year later, you discover a major design flaw, and that beam you paid $1 million for is now only worth $500,000. Well, you have to take a non-cash charge on your books to reflect that loss in value. It is, fundamentally, an admission. It's an admission that a major investment has failed to deliver and has lost significant value. It's a painful admission of a very big mistake. And painful is exactly the right word for it, because what we see here are two completely different realities of Kroger's profit. On the left, you've got the official, by-the-book GAAP number, a fiscal 2025 operating profit of $1.9 billion. But then on the right, you have the adjusted what-if story that management would really prefer you to focus on, an adjusted FIFO operating profit of $4.9 billion. The difference? A staggering $2.5 billion impairment charge. So the question for every single investor has to be, which number is real? The one that includes a multi-billion-dollar failure, or the one that just asks you to pretend it never happened? This isn't just some accounting footnote. This is a chasm between two narratives. Right. So the crucial point here is understanding where this massive crack is coming from. It's a $2.5 billion write-down, and it's tied specifically to their automated fulfillment network. This is not some minor accounting adjustment, okay? This was a major strategic bet on the future of grocery delivery, and this write-down is a crystal clear signal that that bet has gone south in a very big, very expensive way. And while yes, it's related to a specific asset, the sheer size of it just raises some serious questions about capital allocation and strategic decision-making at the very highest levels of the company. And that massive impairment, it isn't the only crack. When we look closer, we start to see several other stress fractures developing. First up, you have significant labor and legal risks. They're in a very public, very nasty clash with the Teamsters, which could easily lead to disruptions or much higher labor costs. At the exact same time, they're fighting class action lawsuits over how they classify their managers. Then you've got the recall and food safety headlines. Frozen food recalls, issues with glass contamination, these things destroy a brand's reputation for quality, and they can really scare customers away. Trust is so hard to win and so easy to lose in the grocery business. And finally, we're seeing them prune their portfolio with ongoing store closures and layoffs. Management will call it optimization, sure, but it can also be a signal that certain markets are facing some pretty serious underlying challenges. Each of these might just be a small crack on its own, but you put them all together, and they can weaken the entire structure. Okay, so we've examined the steel frame of the bull case, and we've inspected the very real cracks in the foundation. So now let's look at management's plan to actually fix it all, the 2026 blueprint. Think of this as their architectural plan for how they're not only going to repair the damage, but also continue building upwards. Look, any structure can take a hit. What really matters is the plan to reinforce and grow from there. And on paper, I have to say, this blueprint looks confident. They're guiding for identical sales growth of 1% to 2%, and that's even after factoring in some known headwinds. They are projecting an increase in their adjusted FIFO operating profit, taking it to a range of $5.0 to $5.2 billion. Adjusted EPS is also guided higher, to somewhere between $5.10 and $5.30 per share. But what's really critical here, what really caught my eye, is that they expect to generate a very strong $2.7 to $2.9 billion in free cash flow, even while they're planning to spend nearly $4 billion on capital expenditures to improve the business. This is an aggressive blueprint for both investment and growth. But hold on a minute here, we have to ask the skeptical question. Is this blueprint actually realistic? I mean, how can a company so confidently project growth in profits and cash flow when we just finished identifying a multi-billion-dollar write-down and a whole host of operational headwinds like labor disputes and brand-damaging recalls? It feels a bit like the blueprint is being drawn up without fully accounting for the shaky ground it's supposed to be built on. Are they just telling us to ignore the $2.5 billion elephant in the room? Well, that is the billion-dollar question, isn't it? And the CFO, David Kennerly, he actually tackled it head-on in the report. He says, and this is a direct quote, "This guidance reflects our ability to invest more aggressively, funded by e-commerce reaching profitability, meaningful procurement efficiencies, and productivity gains across the business." So their blueprint isn't ignoring the costs. In fact, it's explicitly stating how they plan to pay for everything. Their funding is coming from three key pillars: getting that e-commerce business to finally make money, which we already talked about, squeezing more costs out of their supply chain, and getting more productive across the entire company. This is their detailed roadmap. All right, we've run the full structural stress test. We have examined the steel beams of the earnings beat. We have found the cracks in the foundation, from those impairments to the operational risks. And we have reviewed the blueprint for their future construction. Now it is time to weigh all the evidence and deliver the final iron financial verdict. Is this Kroger structure built to last, or is this a teardown just waiting to happen? So let's just recap the analysis real quick. We started with the steel frame. That's the powerful earnings beat, the massive capital returns to shareholders, and that very strong e-commerce growth. That shows us a solid operational core.
But then we found the foundation cracks, and that $2.5 billion impairment is a major red flag that absolutely cannot be ignored. Plus, the operational headwinds from labor, from lawsuits, and from recalls, those are real, tangible risks.
And finally, we analyze the blueprint, which is a confident and, this is the important part, a funded plan for future growth. After putting all of these pieces together, our final verdict is this: structurally sound, but watch for stress fractures. The core business, that ability to generate sales, to beat Wall Street estimates, and to return billions to shareholders, that is incredibly strong. That steel frame is solid. However, the cracks they identified are not just cosmetic. The impairment charge was a significant strategic misstep, and the operational headwinds require vigilant monitoring. These are not the kinds of risks that investors can afford to just ignore. The building is standing strong today, for sure, but you absolutely need to keep a close eye on those fractures to make sure they don't spread. So here's the crucial point. The ultimate key takeaway for any investor looking at Kroger today, it all comes down to one final provocative question. Is management's blueprint strong enough to not just patch over these cracks, but to fully repair them before they have a chance to spread and compromise the entire structure? The company is sound for now, yes, but its long-term durability rests entirely on their ability to execute that repair and growth plan flawlessly. The heavy lifting, believe me, is far from over.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.